Greetings from India. You are listening to the Businesstalk podcast. I am Deepak, your host for today's episode. We are delighted to welcome Dr. Jean-Edouard Colliard, Associate Professor of Finance at HEC Paris, as our esteemed guest on today's podcast. Before joining HEC, Professor John spent 2 years as an economist in the Directorate General Research at the European Central Bank. Dr. John's research focuses on the regulation of financial institutions and the microstructure of financial markets, exploring themes such as the role of artificial intelligence in finance, financial transaction taxes, bank capital requirements, and the European Banking Union. His work has been published in top-tier journals, including the Journal of Finance, Review of Financial Studies, Review of Finance and Management Science, where he also served as an associate editor. Dr. John is a member of the Finance Theory Group, a CEPR Fellow, and a research affiliate of the European Money and Finance Forum. His research excellence has been recognized through several awards, including the Best Young Researcher in Finance and Insurance Award, the HEC Foundation Research Award, the Young Researcher in Economics Award, the Eurofidei Bedofi Data Award, the Young Researcher Award, and the European Money and Finance Forum, UniCredit and Universities Foundation First Research Prize. In this episode, Dr. Jean-Edouard Colliard dwells into his fascinating research, regulating finance in the age of AI, risk, reward, and the future of supervision. So without further delay, let's welcome Dr. John to the podcast. Dr. Colliard, it's a true privilege to host you today. Thank you for taking the time to join us and discuss your work.
Thank you for having me. It's a great privilege for me. Thank you.
Professor, how is artificial intelligence reshaping the microstructure of financial markets, particularly in the areas like algorithmic trading, liquidity provision, and price discovery?
Okay, thank you. That's a great question. Actually, it's a research question. So there is research currently on exactly that. First, I think, there is a trend, before, now we talk only about artificial intelligence and so on, but in the 2000s, we had, we had algorithmic trading and high frequency trading that appeared on securities markets, in particular in the US, but then later on, pretty much everywhere. And they have become increasingly sophisticated, right? And so one way to think about current, developments of artificial intelligence on markets is that, maybe it's just more of the same, basically. So, 15 years ago, we had already, some neural networks, algorithms being deployed on markets and trading on signals with very little human involvement. And maybe, what we are witnessing right now is just another step in the same direction. So I think what's interesting about the current research is to try to think, is there something really special, basically, about artificial intelligence, or is it just, another step towards automating more processes in markets? And so one hypothesis that we explore with some co-authors, but that other people are exploring too, is that maybe what's interesting is the fact that now we have algorithms that interact together without human involvement, and they learn in a very specific way because, for instance, they might use reinforcement learning. And so that's a very different way of learning from, Bayesian learning, for instance, or from statistical learning. And so with some co-authors, we try to think about, okay, what can this imply? And so we have a recent work with my colleagues, Thierry Foucault and Stefano Lovo, where we run, experiments between different trading algorithms on an artificial market, and we see whether they are good at putting quotes on the market, how does liquidity evolve, what happens on the market, and so on. And so we realize in particular that one issue with reinforcement learning is that you have these different algorithms. They have to experiment different prices to learn, what's the best way to behave on this market. But they all do this simultaneously. So, they try to learn how to behave in front of another algorithm, which is trying to do the exact same thing. And so basically, the fact that they are all experimenting and learning at the same time, they are kind of, creating noise basically for each other, okay? And so in particular, what we show is that in this type of environment, the algorithms, are good at learning. So they are going to learn, profitable strategies. They are going to learn how to deal with different frictions on the financial market, but they are not going to learn perfectly. And so in particular, in our setup, these are algorithms that are used for market making. And so we show that they are not going to learn a very, very competitive outcome. Instead, they are going to keep relatively wide spreads. And the reason for this is that they don't learn to be perfectly competitive because, there's just too much noise that they are creating for each other, basically, right? So that's a bit of a thought experiment, if you want, through computer simulations, but that's one of the reasons why, it might be very different when you have reinforcement learning algorithms that make prices instead of humans or instead of other types of algorithms. And so there is more research, that's developing in this area. So that it's a real research agenda basically currently in the literature on microstructure.
Professor, what aspects of AI-driven financial activity do you think current regulatory frameworks are least equipped to handle? Are there blind spots that central banks and policymakers should be most concerned about?
Mhm. So here again, I think regulators of securities markets have struggled already with previous innovation waves. And so in particular, high frequency trading that has always been very difficult for regulators to handle, because now, if you are a securities markets authority, you have to deal with, enormous amounts of data, extremely fast trading, and you have to regulate agents that are no longer humans, basically. And so sometimes, you might inquire into a trading company and try to understand what they do. And they are going to tell you, "Oh, actually, we don't really know what we do. We just have an algorithm that extracts, signals from some data and from the market and trades profitably on those signals. But the algorithm is a black box, so we are not sure exactly why the algorithm, picks up on this signal and not that signal." Okay, and so that makes it very, very difficult for regulators. And so, in particular, there has been a lot of debate in the past, 20 years or so, on a variety of strategies called, spoofing, or, more generally, manipulation strategies, where the big issue for securities markets authorities is that you don't want, you want to prevent people from manipulating the market. So, I could code an algorithm that's going, for instance, to put a lot of orders to buy a certain security, and then it's going to cancel all these orders. But maybe the fact that I put many orders to buy is going to move prices, upwards, for instance. And so then I might, sell and benefit from this inflated price. Okay. So this is manipulation. I can go to jail if I do that. Okay. But in order to send me to jail, the regulator has to prove, in the US in particular, the SEC would have to prove that I did that voluntarily, okay, that I really put all these orders because I wanted to manipulate the market and trade on the other side. If you code an algorithm, it could very well be that the algorithm learns this type of strategy automatically. And it could very well be that the coder of the algorithm is not even aware that the algorithm is doing that, or not even aware that the algorithm is doing that because it's profitable, because it's manipulation, right? And so that creates a huge challenge for regulators. It's not really new to artificial intelligence. This was already a challenge, 10 years ago. But if we have better algorithms and they might learn, more and more sophisticated strategies, the risk is that they might learn more sophisticated manipulative strategies, and they are already very, very difficult to regulate. So that's one issue. Another issue that has been studied in the literature, there is a growing literature on the problem of algorithmic collusion. So that's the risk that, these different algorithms, they interact together and they settle on equilibria, if you want, in which instead of competing with each other, they maintain very high prices. So if these are market-making algorithms, for instance, they could maintain very wide spreads. Or if these are, other forms of trading algorithms, they could do all kinds of, coordination that they are not supposed to do, and that is in principle illegal. But they might learn autonomously to do these kind of things. And so there is a very interesting paper by Du, Goldstein, and G, where they show that exactly this type of thing can happen on financial markets under certain circumstances. And so that's also clearly something that regulators should worry about. And finally, a last thing that I think is important is the problem of instability. And there has been, again, in the past 20 years with HFTs, there has been more and more debates about flash crashes and instability, the possibility that algorithms might react very quickly in very unpredictable ways, and that prices might move too fast, or maybe liquidity might decrease too quickly. And so that's also a risk that regulators have to think about clearly. And so all those things, I mean, I don't blame regulators. These are very, very difficult issues to tackle, and these are definitely things that regulators should be better equipped to deal with.
Professor, as financial institutions increasingly rely on AI for risk modeling and decision making, could we be introducing new form of systematic risk, especially if models share similar structure or training data?
Mm-hmm. Right. So that's also a concern, right? So that's definitely possible. So the concern here is that in a way we get the strategies of everybody become extremely correlated because they use the same, they could use similar data and they use similar algorithms to deal with this data, right? So it's a bit, you have this, these apps, for avoiding traffic, for instance, like Waze. But if, the app gives the exact same advice to everybody, you generate, more traffic jams through the app, okay? And so the same can happen on financial markets. You can have, it's the issue of, it's called in the literature, we call that, the crowding effect. So you have trades that become crowded because everybody tries to do the same type of arbitrage strategy. And so, so there is some literature, showing that this is possible. And so there are, setups in finance in which we know that you can have, self-fulfilling crises, for instance, where, if bank runs would be a very famous example. Okay. So if everybody wants to withdraw their deposit at the same time from a bank, then the bank might collapse, even though, the bank is doing well. So that's possible. In securities markets, it's not always completely obvious because on a stock market, you have a price basically. So if everybody tries to do the same thing at the same time, the price should adjust, and that should discourage you from doing this basically, right? So if we all try to sell at the same time, the price is going to collapse. But precisely the fact that the price collapses gives you an incentive to maybe not sell and wait in case the price will go back up later on. Okay, so it's not completely obvious, and there are some very interesting papers right now that try to look at this type of environment with algorithms. There is a very nice paper by Hao Yang from EM Lyon in France. He looks exactly at this type of situation, and he shows that this is indeed possible. And there is a very recent paper by Kartik Anand from the Bundesbank and co-authors where they look at this type of situation more in a banking context, and they show it's possible. But again, it depends a lot on the context and what market we are talking about. So I think in securities markets, that's definitely a concern because you have a lot of algorithms that interact together. However, there is a price mechanism as well, right? So it's not necessarily completely obvious how this will happen. In other contexts, it might be a little bit different. And again, this is not necessarily completely new, right? It's just that this might become even more frequent. So, a very famous example was in 2007, there was an event called the Quant Meltdown. So it was an event in 2007 where a lot of quantitative hedge funds had taken very similar positions because they were using the same type of factors, the same type of signals for their trading strategies. And so they all wanted liquidity at the same time, and they really suffered very large losses. So what's possible is that those things are going to become more common. But again, at the same time, the price is going to adjust again, right? So if indeed, all hedge funds start, using the exact same signals for trading, well, the value of these signals is going to decrease a lot, and there's going to be less hedge funds. So there is, the prices give you an incentive to do things that the others are not already doing. And we know that, the impact of AI on hedge funds and a lot of quantitative funds is already very, very strong. And these people have been very, very fast at adopting this new technology. And so that's going to have a big impact. I have a paper with my co-author, Junli Zhao, at the moment, where we try to think about, what's going to be the impact of AI on mutual fund managers and hedge funds managers, what's going to be the impact on employment in the financial industry. And so that's something very interesting to think about.
Professor, AI models often operate as a black boxes.
Mm-hmm.
How can regulators balance the need for model transparency with the competitive edge that opacity sometimes provides in trading and asset management?
So that's again, there's been a long debate about this, right? So in the past, a long time ago, you would use statistical models that would be very simple, like, OLS regressions, where you would choose the different variables. And so then you would know exactly, why you chose a specific variable. And so these models were called explainable. Okay, so you can explain, for instance, to a borrower why you are not giving credit to him or her. Okay, and so then we had, more black box models, like, neural networks, for instance, where it's not clear at the end of the day, why you give a certain, why you take a certain decision. And so because of this, actually, in Europe, for instance, we have a regulation that mandates explainability. So in Europe, if I give credit or I don't give credit to someone, and the decision was taken by an algorithm, my customer has a right to ask me for an explanation, and I have to provide an explanation. I cannot say, oh, I have a black box algorithm and my algorithm doesn't like you. I don't know why, but that's life, So I cannot say that. So I have to explain where this comes from. And in particular, the answer has to be non-discriminatory. I cannot say, my algorithm doesn't like you because of your gender or your race or where you live and so on, right? And so that creates, of course, a constraint for the financial institutions that use these algorithms, because they have to think about using a method that is explainable and non-discriminatory. And the problem is that, of course, we have a lot of research showing in particular that it's very difficult to be non-discriminatory, in the sense that, of course, you are going to not use certain variables as predictors, but it could be that your algorithm ends up guessing the variable, in a sense, right? So for instance, I may say, okay, I don't want my algorithm to do statistical discrimination based on race or gender. But if I have your address, your income, where you work, and so on, I might guess those variables very easily. And so a neural network algorithm implicitly is going to guess those things and might end up discriminating against certain groups. And so there is a large literature on this. So here, fortunately, there are methods to do that, basically, right? So it's possible to find ways to make those things explainable, and so there are statistical methods to do that. In asset management and trading, I think the important thing is really to ask traders and asset managers to be able to explain their strategy, in particular because you want to make sure that what they are doing does not rely on some form of market manipulation. But here I think generative AI in particular is very interesting because it's very good at giving explanations, right? So if you have a neural network that tells you you should pick up on this signal and trade in this particular direction, it's a neural network, so it cannot really tell you why. It cannot provide a text and an explanation. So you have to rely on extra statistical techniques to see what are the features that really explain the decision and so on. It's a bit complicated. If you pair this type of method maybe with some LLM, or a generative AI model more generally, it could be that the generative AI is going to provide you with a text explaining what is the strategy and why it expects the strategy to work. So it's a bit like having a human quant who is going to do a statistical analysis and then find some intuition or some rationalization for the analysis. So my hope here is that actually the new advances in AI, they might change this. They might make a lot of things more explainable, and that might help the regulator a lot, because now if you have a hedge fund that tells you, oh, I have this strategy, it works, but I can't really tell you why. Now you can say, well, look, it's easy to say why, because you could just, use maybe your AI tool should have this capacity to explain the strategy, basically, right? So we can be more demanding because the methods have improved. And so I think that's an interesting development.
Professor, do you see central banks adopting AI-based supervision tools to monitor markets in real time? And what might AI supervising AI looks like in practice?
Mm-hmm. So there is a recent paper by Aldassoro and co-authors, so people from the Bank for International Settlements, the BIS, where they had a survey of many central banks and asking them, are you already using AI? And I think here it was in the context of cybersecurity. And so the results of the survey is that most central banks are already using AI. And actually that was last year, okay? So probably they are using it even more now. So it's clear that regulators and central banks are using AI. Of course, it creates a lot of issues, because how do you make sure that they are using the right tools, that they don't share confidential data with ChatGPT, which may or may not use this data to do something else, and so on. So you have all these types of concerns, but this is already happening, basically, right? And so then I think what your question suggests is that we may go even further. That it's one thing to use ChatGPT to make your operations smoother and these type of things. You could go even further and say, okay, we have financial markets in which you have a lot of algorithms that interact together. Maybe one of these algorithms should be a regulatory algorithm that should regulate the other algorithms in real time and maybe at high frequency if we are talking about a stock market. So I think from today's perspective, this is still a little bit science fiction, but it starts to be reasonable to speculate about this possibility, basically, right? And so here I think in some contexts that could be very interesting, because we still have, for the regulation of securities markets in particular, we still have to rely on very, very simple rules. Okay, so for example, I think a good example would be circuit breakers. So on many markets, you will have rules that say that, if the price for a certain security moves too much one way or the other, or if liquidity drops too much, you have a lot of rules like this. If you cross certain boundaries, then we are going to suspend trading for a certain amount of time, okay, which could just be a couple of minutes or could be the rest of the day or whatever, okay? There are different rules depending on the market you are considering. And of course, these rules are very, well, like all rules that you determine ex ante, they are going to be good rules in certain cases and bad rules in others, and you are just taking a decision that seems to be good, like on average. Potentially, if you had, a regulatory AI deployed on the market, you could fine tune the decision much more. So you could imagine, programming an algorithm that's going to watch, in real time what happens on the trading of a certain security and take the decision to suspend the trading for a certain amount of time, depending not only on a couple of variables like we do today, but on a lot of things and on, forecasts about, is the market more likely to be very liquid, very inefficient, or to crash now, and this type of things. Okay, so that could be an interesting avenue for regulators to exploit. You could do the same thing with manipulation. You could try to see, in real time, do you have the impression that one of the other algorithms is behaving in a very strange way? And can you maybe try, to trick this algorithm, a little bit? Would be a bit like a policeman in civilian clothes, basically, who would be on the market and would maybe try to do certain things to see how the algorithms react and test whether they are manipulating the market. So you could imagine a lot of things, right? So for the moment, I think there is very little research on that, because again, this is still a little bit, I'm not sure the regulators are that advanced yet. That's definitely something to think about for the future. And also because if regulators don't do that, I think there will be a huge gap between the timeliness of actions of market participants and the timeliness of actions by regulators, right? So I think regulatory authorities have to be a bit forward-looking and think about this type of possibility, definitely.
Very insightful. Professor, given the borderless nature of financial data and AI systems, what challenges do regulators face in achieving international coordination, especially across the EU, US, and emerging markets?
So that's a very good question. So it's a very important question about regulation in general, right? So in the past, for instance, I worked on, we in the euro area, we have now, a common banking supervisor for all the large banks. And so this is a novelty. This is something that appeared in 2014. So because we had this issue of having different regulations and different supervision authorities in different countries, and this created all kinds of issues. And so we chose to centralize the supervision of European banks. And at the moment, there is a big debate about doing the same in the EU for capital markets, okay, in particular for stock markets. So very, very recently, in the past couple of days, actually, the German chancellor said, it would be nice to have a single stock exchange for the European Union instead of the current situation where we have, one exchange per country plus others, okay? And so that's always an important debate, which goes way beyond, stock markets and artificial intelligence. And so the common argument in this type of setting is a famous argument called the race to the bottom. So in particular in banking, the idea was always, okay, if I'm the French regulatory authority and I think about how to regulate the French banks, what I'm going to think is that, well, if I regulate them in a very tough way, that's going to decrease lending in France. That's going to favor, foreign banks operating in my country. And if I don't regulate them very well, I run the risk that those banks are going to fail. That's going to be bad for my country, but that's also going to be bad for a lot of other countries because these banks are international and so on, right? And so the idea here is that basically, if you are a tough regulator, that's bad for your domestic country, and that's good for your country, but also for a lot of other countries. So basically, when you are tough, you are creating a positive externality on others. Okay, so it's a bit like carbon emissions, for instance, right? So if you set very, very high standards for emitting little carbon, okay, so if you constrain your industry a lot, then your industry is going to suffer, but the whole world is going to benefit. Okay, and so in this type of situation, we expect, an inefficient outcome. Basically, that in the case of pollution, everybody will pollute too much. In the case of financial stability, that everybody will be too lenient with their financial sector. Okay, and so that's a very well-known argument for banks. That's the reason why we have the Basel agreements, for instance, the Basel standards for banking supervision. They were really historically the source of this, the consequence of identifying this problem. Okay. For securities markets, I've always thought it's a little bit different in the sense that I'm not sure these cross-border externalities are huge. I think they are big for the US. Okay, if the US stock market crashes, that's going to be a big issue for everybody else in the world, but that's very specific to them. I don't think that's true for most other countries. And another issue is that even stock exchanges themselves have an incentive to self-regulate, So imagine, there's a lot of debate about high frequency trading, for instance, okay? And so imagine I run a stock exchange, okay? So the stock exchange is a private company, and so, I just want to make profit. I run my stock exchange and I let HFTs do completely crazy things and rip off investors and behave in a very bad way, okay? Then a lot of other investors are going to avoid my exchange because they are going to think, well, I don't want to trade on this exchange where I'm at a disadvantage and I'm getting ripped off by more sophisticated players. And so my business is going to be, to be lower, and I'm going to be less profitable. So actually we see exchanges themselves making efforts at maintaining a certain balance between different market participants. They certainly don't do it perfectly, right? But I think it's quite different from the banking context in the sense that the incentives are a little bit more aligned. Okay, so the stock exchange has an incentive in making sure that trading is relatively fair. The national authorities of a country have an incentive to make sure that the stock market operates well so that their companies can get good financing conditions on the stock market and so on and so on. Okay, so I'm not 100% sure that the issue is as bad or as urgent as in banking regulation, let's say. But of course, they can still be spillovers. I think, in particular, the way market participants are regulated in the US has a very big impact everywhere else, right? So, for instance, at the moment, under the Trump administration, it's very clear that there is a push for more lenient regulation in the US. It's going to be difficult for all the other countries to maintain much higher standards than in the US because there's going to be a lot of pressure from market participants. Maybe that's a good thing. Maybe there was too much regulation in the US. We'll see, right? But that's going to be an interesting couple of years in terms of regulation of financial markets.
Professor, how
And
can
yes,
we...
sorry, there was one part of the question was also about developing economies. So I think that's also a very interesting dimension. So there is this well-known paradox in economics. It's called the Lucas paradox. And so this paradox is still true today. It's the fact that, we see a lot of money, a lot of savings flowing from developing countries to developed countries, in particular to the US. So everybody's investing in the US. Economic theory would predict the exact opposite. Okay, so economic theory would predict that the return on investing capital in developing economies should be much higher than the return on investing capital in developed economies. Okay, in principle, you invest, an extra $1,000 in the US, well, they already have a lot of machines, a lot of capital, a lot of intellectual property, a lot of skilled labor, a lot of everything. And so the return on the extra investment should be much lower than investing in developed economies. Okay, and yet in reality, we see the opposite. And so there are many explanations for this. Part of it is, how easy is it to invest in the stock market? What are the frictions on the stock market? How liquid is it? How well protected are you as a shareholder and so on. And so there again, I hope that, AI will be another opportunity for many stock markets in developing economies to attract more investors from abroad for a lot of reasons, right? So for either the market may become more liquid, it might become, easier to trade in that market, or even very simple things like, accessing the regulatory documents of companies, making sure, in many countries, it's just difficult to get, financial documentation in English, for instance. Okay. And so with AI, now it's very easy for companies to produce that. So the hope is that, this is going to help a lot of countries attract a lot more capital, and that, finally we are, that going to contribute to reverting this Lucas paradox. There is a nice paper that I wanted to mention here by Campello, Kong, and Dietrich on, on this idea of how to regulate innovation. So, it's a setup in which you have, a financial market, there are financial innovations. As a regulator, you realize that there is some potential for good, but that there are also some risks associated. And so how do you deal with this intertemporal trade-off? Should you experiment this innovation a little bit, but be ready to regulate it at some point? And so it's a very nice, paper to read, to think about, this type of issues.
Professor, financial markets thrive on information symmetry. Does the rise of AI and its ability to process massive data sets threaten to reduce the symmetry, or simply shift it towards those with superior technology?
Right. So here I'm going to be a little bit pedantic. It's just a notion of vocabulary. There are two things that are a little bit different. So one is, differences in beliefs. Okay. So it could be that, I have a certain belief about Tesla, for instance. I might be very optimistic about Tesla in the future. You might be very pessimistic about Tesla in the future. And you don't really value my opinion because you think I'm an idiot, and maybe I don't value yours, and we are very happy to trade together because we both think that the other is wrong. Okay. And so that's called differences of beliefs. So it's a bit like on betting markets. Okay. So I bet that a certain team is going to win. You bet that the team is going to lose. For some reason, we completely disagree about the prospects of this team, and still we are happy to trade together. Okay. Asymmetric information, it's a more complex situation in which you realize that I'm positive about Tesla, and you think, oh, maybe Jean-Edouard knows something about Tesla. And I realize that you are negative about Tesla, and I think, oh, maybe Deepak knows something bad about Tesla. Okay. And so that's a situation of asymmetric information in which we both have a piece of information. We don't know what's the information of the other, but we realize that this information may be valuable. Okay. And so what research has shown is that in a situation of differences of beliefs, okay, then this can generate a lot of trading. Okay, so for instance, trading volume on many betting markets is very high. A situation of asymmetric information has a tendency to reduce trading volume a lot. Okay, because if I have to trade with you and I think that maybe you know something that I don't, then I don't want to trade with you. Okay, because if I buy a stock from you, I'm going to think, well, the only reason why you are selling it to me is because you know something negative. Okay, and you are going to believe the same thing, that the only reason why I buy is because I know something positive. Okay, and so it's very interesting to think about, with new technologies, are they going to create differences of beliefs, or are they going to create asymmetric information, and what's going to be the impact? And so I think at this stage, it's still very much an open question. It could be that you create even more asymmetric information, or as we said before, it could be that signals become more correlated, and so people trade more in the same direction, and so on. And I think for the moment, that's still not completely clear. And I think it could really go both ways. There is a very nice article by my co-author Junli Zhao from Base Business School, where he looks. So it's not exactly AI, but it's about the role of technology in finance. And so he looks at a technological change in the US in 2009, where they made it much easier, basically, for algorithms to read the financial statements of public companies. Okay. And so you would think, well, okay, this is a technological change that is favorable to traders who use machines in the first place to read the statements. And so that's going to create a bigger gap between the more sophisticated players on the market, who are going to use this new possibility to trade more quickly, and the others. And what he shows is that it's a little bit more subtle. So, what happened at the time was that the most sophisticated funds, they had already developed algorithms that were reading the information, even though it was not in machine readable format. Okay, so they were reading things that were not meant for machines, but still, it was possible with some effort to do it. With the change, you had more sophisticated market participants who were now able to do the same thing. So it basically, leveled the playing field. So if anything, it reduced asymmetric information. I think the new developments of AI, the jury is still out. Okay, so it could very well be that it's going to benefit the most sophisticated players the most. Okay, that they are going to make the most of this new technology, and that the gap between the most sophisticated hedge funds and the rest of us is going to increase. It could very well be the opposite. It could be that now everybody can ask ChatGPT, what do you think about this company? And actually maybe ChatGPT is very good at answering this question, and we will all be more on an equal footing when trading a particular stock. So I think it's still very early. So both scenarios are definitely possible, but these two scenarios have very different implications, right? So in one case, liquidity, if you have more asymmetric information, liquidity will decrease. If you have less asymmetric information, it will increase. And so the consequences also for retail investors are different. So I think all this will be quite fascinating to follow. If I have the time, I just want to talk very, very quickly about an experiment we did at HEC, which I found was very interesting because it says a lot about asymmetric information. It's also related to your earlier question about also artificial intelligence in lending. So what we did with my colleague Johan Humbert is that we teach a course of finance for data scientists, and so we simulate. We have a game basically where we give them a lot of data, which is consumer lending data, where they see a database of consumers and how much money they make, what's their job, a lot of characteristics, and whether they repaid their loan in the past. And then we ask them to have a new lending decision. So do they agree to lend money to a specific borrower? Okay. What's interesting is that we have different teams. They all lend to the same people, to the same borrowers, but each team is observing something that the others don't see. Okay. So there is one team where they observe the social network activity of the borrower. There is another team where they observe some trading data about the borrower and so on. Okay, so everybody's observing something different. And so basically what we did there is that we created a lot of asymmetric information, because you should realize that if you make an offer to a particular borrower and the borrower accepts your offer, it means that the other lenders did not want to lend to this borrower at such a good interest rate. Okay, and so maybe the reason is that they have very negative information about that borrower and you don't know that. Okay. And so we play this game, and we see that our students, they are extremely good at processing the data. Okay, so they are very, very good at forming a forecast about the probability that the borrower is going to repay. But typically, when we play this game, they lose a lot of money. And the reason for this is asymmetric information, that they are consistently lending to borrowers that they score very high. But these borrowers got low scores from the others, and so actually they are losing a lot of money. Okay, and so asymmetric information is really something super important, super difficult to deal with. And in particular, my experience is that coders, program, if you have a more data-based view of the world, a less economic, and a view which is more based from engineering and less based on economics and management and so on. Typically that's the type of problem that you are going to ignore. Okay, and so that, I think, in many applications that's going to turn out to be a problem, that you have the impression that it's very easy to forecast something, but you completely forget about important things like asymmetric information. So again, I expect that we are going to see some interesting phenomena there.
Professor, how can academic research in financial regulation and microstructure contribute to smarter, more adaptive policymaking in this fast evolving AI landscape?
Right. So academics, they interact a lot with regulators, actually. Okay. So for example, at HEC, we have this chair with the French banking authority. We collaborate with with the Bundesbank, the German central bank, with the European central bank, and so on. And so there's really a lot of non-academics and people who are neither academics nor regulators don't necessarily see that, but actually regulators and academics, they talk a lot to each other. Okay, and so they influence each other a lot as well. There is even research showing that. And so I think academics, the big advantage that they have is that they have more time, so they don't have to produce business decisions every day and so on. So they can take the time to look at the data for several years and really think deeply about something. So that's a huge luxury that we have. Another advantage is that we see more systematic data basically, right? So in a company, typically, you see your own activity, but it's more difficult to get like a systematic view about what the others are doing because what the others do is their own secret information. You are not supposed to do it, right? And so when academics collaborate with regulators or central banks, they can see the activity of everybody, which is something that nobody else can see basically. And so that's great because you can really think not only about, if you work for a company, you are going to see the activity of your own company and you are going to be very focused on that. And it's normal, it's your business. If you are a regulator or an academic, you are going to think about the entire system. And so how does this particular company interact with all the others and how does the system work out and does it lead to a good outcome or a bad outcome? Are there problems? Are there ways to make the outcome better for everybody? This type of question, right? So more like systematic view. And I think that's really what economists in particular are trained to do. So just to give you maybe an example that I find very interesting about what academics can do, I think they are good at speculating also basically, right? That realizing that there is something interesting and making people aware of that. So there is a very interesting piece of research from a couple of years ago by Berg, Burg, Gombovic, and Puri. What they found was, they had some data on, again, consumer lending. And they showed that actually, if you want to know whether someone is going to repay a consumer loan, it's very, very simple to forecast this very well, simply with the digital footprint of that person. And so, for instance, I think it was a US database. If you know whether the person, is asking a loan using, an iPhone or an Android phone, that's already a very, very good predictor. So if you use an iPhone, it's much more likely that you are going to repay a loan, for instance. Okay, which is quite striking. It's just like a statistical regularity. And so first, that's interesting to see. But what I find fascinating about the paper is that they are really good at really thinking through the implications of this, right? So there are some implications, for consumers that, you might be discriminated based on a lot of signals that happen to predict your behavior in the future, even though it's just a correlation. It might be completely incidental whether you use an iPhone or something else. So that's one thing. The other thing, which is very interesting for the future, I find is what we call in economics the Lucas critique. So the idea that imagine that some lenders start to really use those things to decide whether to give you a loan. Okay. At some point, the consumers are going to realize this. They are going to realize, oh, but it's weird because I asked for a loan with my Android, and I did not get it. But my brother, who has exactly the same income or whatever, he has an iPhone and he got a loan. So maybe they are using this. Oh, maybe I should borrow my brother's iPhone to borrow next time. Okay, so people are going to adjust their behavior. They are going to realize that some types of behavior should be avoided, and then the predictability is going to disappear. This means that the algorithms on which the lender is relying are going to break in the future. And so I think that's something very important at the moment. I think we are still at in a period where we are using a lot of legacy data, where you can predict a lot of things, but a lot of those things are just correlations. And so over time, in a lot of contexts, humans, they are not like particles in physics, they react to what you do. Okay. And so the humans are going to adjust their behavior, and a lot of the statistical relations that we had in the past are going to break down. And so my forecast is that, a lot of applications of data, AI, and so on, in the long run, are going to disappoint because, they exploit correlations that are weak, basically, that are only correlations and might disappear if you try to exploit them too much. Okay, and so I think it's just speculation, but it's like an academically informed speculation that I think is interesting. Another thing where academics are very important is just to also provide really normative advice, right? So you can really see that basically in research when you compare the research of economists and a more database, more data science type of research, basically. So if the question of a central bank, for instance, is What's the impact of increasing capital requirements on lending, okay? Or in the context of securities markets, what's the impact of regulating the tick size, or what's the impact of banning short sales or whatever? You can answer this question with with data. Okay, you can say, okay, let's look at such experiments in the past, see what happened. You can be more or less sophisticated about this. It's not a trivial thing to do, right? But with data, you can get an answer to this question. But now there is another question, which is, okay, imagine, what's the best thing to do? Okay, imagine we have a new problem and we ask, how should we regulate AI? Well, we don't know because, AI is new. We don't have data about past regulations of AI, so we cannot really answer this question just with data, okay? And that's where you need to have, you need to be able to build a counterfactual. So you need to have, an economist who is going to build a model and say, based on what we know more generally about markets and how people adapt and so on, this is, what is likely to happen if we do this or if we do that. And I can try to measure, how good would be this situation relative to that situation and give advice. Okay. And so there, I think academics are very, very useful. It's whenever you have a normative question like this, what should we do? It's a much more complicated question to answer than what is currently happening, right? So that's because you need to think about the counterfactual and you need to have a theory of what is a good outcome and what is a bad outcome. Okay. And these are, I think, more interesting questions and also much more difficult to answer.
Professor, I'd like to conclude this episode with one last question. If you were to advise future regulators or central bankers, what three priorities would you highlight for governing finance in the next decade of AI-driven innovation?
So that's a good question. Okay, so if I could say three things to a regulator, okay, so one which is obvious is I think regulators, but they are aware of it, so it's not very precious advice, but they really need to tool up. Okay, so in particular for stock markets, the previous innovation was high frequency trading and algorithmic trading. Regulators pretty much everywhere have done a lot of efforts at catching up and be able to think about the algorithms, collecting more data and so on. But I think the gap between regulators and the industry has only increased, despite again the best efforts of regulators. And the reason is not that regulators are not good or whatever. It's just a question of funding. Okay, it's just that if you need regulatory authorities to have enough funding to maintain very large databases, hire very good data scientists, hire computer scientists, and so on and so on. Okay, and so that's a non-trivial investment. But if you want to have a well-regulated financial market, which I think is very important to have a well-functioning market in the first place, it's totally worth investing. At the end of the day, we are talking about hiring, maybe 100 experts if it's a big market. Okay, so it's costly, but at the level of a country, I think that's an investment that's well worth making. So we need to make sure that regulators have the capacity to hire the best people to really follow what's going on in the industry. This has always been an issue. It has always been important, but I think with AI, it's probably becoming even more important than before. And again, I mentioned this collaboration between HEC and the French Banking Regulatory Authority. It's exactly an example of, I think, something which is very important to do. So to make sure that the regulator is tooled up and follows what's going on. Another issue is to really think about the economics and the interaction between different players. Okay, and so in particular, I think one danger in general is that we tend to focus a lot, because there is now AI. The discussion is a lot about the technology, and it was the same with high frequency trading. Actually, everybody was fascinated with the trading speed. Issues of collocation, how do you make sure that everybody trades at the same time? So these issues are all very important, but of course you can lose a little bit the big picture, which is these are very sophisticated, very technologically advanced firms, but how do they interact together, and what does that mean for the equilibrium of the market and so on? And the regulator, I think the job of the regulator is really to think about that, right? So I don't think you necessarily need a regulator to think about, what's the best technology, how should the algorithms be programmed, and so on. You can, that's the problem of market participants. The goal of the regulator should really to think about, okay, but they are all using these different technologies. How are things going to, interact together, and what's going to be the end outcome? Okay, and the regulator is the only participant that can see what everybody else is doing and can think about, whether the outcome is a good outcome or not. So I think it's important to not lose sight, basically, of the economics. So you need to combine very sophisticated data and very sophisticated view on the technology with good economic thinking. Okay, and that's not easy because these are even almost different cultures, basically. Okay. And the last thing is really to collect data and follow what happens. I think that's very important. So for instance, there are still debates about the impact of high frequency trading, and the reason for this is that there is very little data, basically, right? So we still, for instance, I mentioned my research on algorithms in stock markets. And it's experimental research. So we say, okay, let's assume that the algorithms that people use are like this. Then what's going to happen is this type of thing. Okay. What's a bit embarrassing is that actually we don't know what are the algorithms that are actually used by market participants, because it's the secret sauce of each market participant, what type of algorithm they are using. And so it's very important that securities markets authorities collect information, that they know exactly what type of algorithm is used, and that they don't have to publish the secret recipe of everybody, but that at least we have some information to inform the academic debate and the public debate, and that we know exactly what's happening, what are the potential risks, and so on. And I insist, regulators are the only ones who are able to do that. So they need to think about what type of data should be collected, what type of data can be shared openly with others, under which conditions, and so on. So in the US, for instance, they are very good at doing that. There were a very interesting example of this is the so-called trace data. So that's data on transactions in the bond market in the US. So in the 2000s, there was a push to increase the transparency of this market, and so the US authorities, FINRA in that case, started to collect data on all the transactions and started, sharing the data for a price, okay, but you can subscribe to their service, and sharing the data with all market participants. And if you are an academic, you can access a more sophisticated version of the data where you see some more confidential information under a non-disclosure agreement. And if you are a regulator, you can see even more information. Okay, I think it's a very good example of what should be done. It's difficult because at the end of the day, it's terabytes of data. You need the lawyers to make sure that everybody's happy with sharing the data and so on. So it's not easy to do. That's why it's typically not done. But I think it's very important. And so regulators should really make a push to collect more data and share more data, because that's going to help them eventually. The regulators on their own, it will be very difficult for them to watch everything, to think about everything, and to generate trust about what they are doing. You need to have enough data to have an open public debate about important issues. And regulators are part of this debate. The industry is part of this debate. Academics are part of this debate. But everybody can be part of this debate. So if you are good at processing the data, you can form your own view, make a point, and so on. And I think that's extremely, extremely important.
Thank you, Dr. John Colliard, for sharing your valuable insights on how artificial intelligence is reshaping the financial landscape and the challenges it's present for regulators and policymakers. Our discussion shed light on the delicate balance between innovation and supervision, and the crucial role of thoughtful regulation in ensuring stability, transparency, and fairness in the AI-driven world. As we stand at the intersection of technology and finance, it's clear that the future of regulation will require not only new tools but also new mindset. Your research continues to inspire deeper thinking about how we can harness the power of AI responsibly while safeguarding the integrity of financial system. Thank you once again, Professor Colliard, for joining us today.
Thank you very much. It was a great pleasure, and it were fascinating questions. So, on many of them, the best I can say is, well, we still need more research on that.
Thank you.
All right. Thank you.